one-day seminar on international taxation. The third session is going to be handled by CA Krishnan, sir. I request Pramod R. Hegde, Vice Chairman of Bangalore branch, to escort sir onto the dais and welcome with a floral bouquet. Krishnan is an international tax professional with significant on-ground practical experience of globalizing a company's operations. He has managed the entire gamut of planning, compliance, tax audits, and litigation in international income tax and transaction tax, due diligence and contract structuring, as well as risk mitigation. He was earlier Vice President and Group Head International Taxation at Infosys Limited. Over a period of 15 years at Infosys, he set up a centralized international tax department in Bangalore to manage tax compliance in over 30 countries across North America, Europe, Asia Pacific, Africa, and Russia. Krishnan has published an elaborate discussion paper on drafting foreign tax credit rules in India. He has written articles on the onerous reporting requirements in the US on its citizens and green card holders residing outside the US, and on tax of alternative investment fund in India. He has authored a book on investing in India and foreign startup companies, providing an overview of the income tax consequences of forex requirements in India. He is a founder member of International Tax Research and Analysis Foundation, an independent and exclusive forum for tax policy research, analysis and support, conducting research and analysis on important tax matters, including those relevant to India. He is presently advising companies on international tax structuring and performs the role of a virtual international tax manager, providing tax health checkup and compliance oversight of international tax, employee mobility and transaction taxes. He advises alternative investment fund in India, US, citizens and green card holders on tax compliances, reporting obligation, and estate planning. With this brief introduction, I welcome you, sir. The session is yours, sir.
Thank you. The biggest challenge for a post-lunch speaker is to keep the audience awake. And the fact that there's a large number of people at the back clearly indicates that they are all people who plan to sleep. So to address that particular issue, today I want to change the format of this presentation. The moment you have a monologue, everybody will go to sleep, some of them making sounds also. So to prevent that, the first thing I want to do is to convert this into a question-answer session. It is generally a practice that all the audience will ask questions to the speaker. This time I want to do the reverse of it. I want to ask questions, you people answer, and then we will discover what foreign tax credit is. That I think is going to be the good format perhaps. So the title for today's presentation is Foreign Tax Credit. So the first question that I want to ask all of you is, what do you think is foreign tax credit? Let's start with the basics. I want answers from all of you, please. Mike, could you get? Even if you don't know the answer, it's okay, but I want somebody to answer. I will not progress unless somebody answers it. I will also come and sleep with you. Let's be clear about it.
Hi sir, myself is Megha. So foreign tax credit is something like we have paid the taxes as per the other countries' law, and we wanted to be take the credit while paying the income tax in India. That is simple definition.
Okay. Anybody else? Yeah, ಅವ್ರು ಕೊಡಿ, ಮೈಕ್ ಕೊಡಿ ಅವ್ರಿಗೆ.
Thank you. Whenever any income is being doubly taxed, that is in the source country and also in another country due to the obligation of any like sort of income which has to be deemed to accrue or rise in India or through any other means, then we pay taxes in both the countries. That is, if we take a case of India, then it is India and any other contracting state. So in that case, usually we are given an opportunity to claim the double taxed credit in the resident state. So that's the basic gist of foreign tax credit.
Brilliant. Both of you have addressed that issue. So the next question for me is, why do you pay taxes in two countries? If you don't pay taxes in two countries, you don't have a foreign tax credit, then you don't have to attend this session. So why do you have to pay taxes in two countries? You pay taxes only in one country.
Due to source rule and residence rule, basically the country which you are a resident from will tax you for all its incomes, like whatever income you earn, whether being due to you being a resident of that country. And source rule basically means wherever, for example, if you are earning some income from foreign country, that is your source country. So they will tax you for income which you have earned in that country.
Brilliant. So I think these presentation slides have been given to you people. Okay. So let us now address the first issue, which is about the tax regime in India. So we are talking about saying that we have to pay taxes in multiple countries. So let us start with India and say what is the taxation regime in India. I'm sure all of you are aware of this because you are all practitioners of India tax. I have never practiced taxation in India except for some of those presentations that I have made to the government. But let us look at this. Taxation of income. In India, essentially, there are two sections, which is Section 4 and Section 5. Section 4 very clearly says that a person has to pay taxes on the total income of the previous year. Previous year is essentially the year in which the income is earned, and then that particular income is taxed either through a tax deduction or through a payment of advance taxes. This is the mechanism of payment of taxes to that extent. And there is a definition of Section 231 for person, which basically includes everybody under the sun. And then if you see the Section 3, which is previous year, it talks about the financial year in which the income is earned. And income, all of you know, there are 5 heads of income in India. You have income from salary, income from house property, capital gains, income from profits and gains from business or profession, and then you have the other income, which generally will have the interest and dividend. So you have the definition of a income also. Now, if you look at the scope of total income, essentially what it says is, subject to the provisions of this Act, it says, in the case of a resident, it is 3 sources essentially, which is one is received in India, accrued in India, and accrues or arises outside India. So there are basically 2 things, which as he rightly pointed out about foreign source income and domestic source income. A and B is basically domestic source income, and C is foreign source income. In the case of a non-resident, foreign source income is not taxable in India. So this is what the fundamental principles of taxation of income in India. Now, what is double taxation? We all talked about, that lady there talked about double taxation. So let us look at what is double taxation, what are the types of double taxation. I want to quickly go through slides because there are many other things that we want to discuss. So as he rightly said, there is a domestic source income and foreign source income. Economic double taxation. There are 2 kinds of taxation. One is economic double taxation and one is called as a juridical taxation. So to that extent, economic double taxation happens when two different persons are taxable in respect of the same income. So the example for this will be typically a corporate taxation paid by a corporation on its income, and the after-tax distribution of that profit in terms of dividends. So there are two individuals. One is the company paying taxes on its income. Shareholders, being the owners of the company, they pay taxes on the income that they received in the form of dividends. So there is two layers of double taxation. There is no credit for this kind of a situation, except in some countries they do provide a credit to the shareholders on the share of profits paid, taxes paid on the share of profits. It doesn't happen in India. And then you also have a very unusual situation where you have a transaction between a parent company and a subsidiary company, and in the case of the transaction is disallowed as an expense for the subsidiary or the parent company, depending on who's raising the invoice. To that extent, there will be again a double taxation, because the person who is receiving the income will pay taxes. In the case of disallowance of an expense, it is an indirect taxation of that income. In the case of juridical double taxation, which is what we are going to address largely today, is basically it arises when the same income is being taxed in the hands of the same person. Unlike in the case of double taxation, two persons, in the case of juridical taxation, it is the same person being paid tax on the same income, but in two different countries. In the case of economic double taxation, the transaction can happen either in the same country or outside the residence country, whereas in the case of juridical double taxation, invariably there is an international tax impact, because it involves two countries to that extent. Now, the juridical double taxation, as it was pointed out, arises because when a particular country taxes the worldwide income, which is basically the domestic source income and the foreign source income of the resident taxpayer, and the foreign company also, the foreign country also taxes income on that particular income because of the residence taxation requirements in that particular country. So it relates to taxation of the foreign source income in two countries, in the foreign country and in the residence country, wherever the individual or the entity is resided. So this results in double taxation. Now, there are two sources of income for a taxpayer, which is a domestic source income and a foreign source income. Domestic source income is essentially the income which is earned in the residence country, and foreign source income is the income which is earned outside the country of residence. Now, if you look at the elimination of double taxation, here again you have two kinds of elimination. So the internationally accepted regime, basically so far as this is the fundamental rule of foreign tax credit. It is only the residence country which gives you the credit. The source country has the first right of taxation. It is always the residence country which gives you the credit to that extent. So this is the fundamental rule. And how is this credit provided? It is generally provided by two methodologies. One is the exemption method, where the income, foreign income, is exempted from taxation in the residence country, and the foreign tax credit method, which is generally followed by a large majority of countries, where the tax paid in the residence country is reduced to the extent of taxes paid outside the residence country or in the foreign country. Incidentally, Article 23, which is the same article in the OECD Model Convention as well as in the UN Model Convention, they also respectively provide two alternatives, which is the exemption method and the credit method. The DTAA is the tool which is used to implement the foreign tax credit. So to that extent, whatever the DTAA says, it is there. Additionally, many of the countries also have unilateral tax credit mechanism, like we have in the case of India, we have Section 91 and the foreign credit rules, foreign tax credit rules 2017, which provide the mechanism for you to claim credit. So you have two mechanisms. One is through the DTAA, and the other one is through a unilateral mechanism, which is under the Income Tax Act, Section 91, and the foreign tax credit rules. Now, this is the pictorial representation, basically to understand it better. So you have an exemption method, you have a credit method. Under the exemption method, the focus is on the income. So the income is exempt from taxation in the residence country to that extent. So they only have a source country taxation. Whereas under the credit method, the focus is on the tax, not on the income. So whatever taxes that you have paid outside the residence country, you take a credit in the residence country. This is the mechanism of doing it. I don't want to talk about the exemption method because India follows the credit method. So let us look at these two methodologies of foreign tax credit. Under the credit method, the residence country includes the domestic income and the foreign source income. in the total taxable income of the taxpayer. If you go back to section 5, you see the foreign source income and the domestic source income being taxed. That is what it is, and calculates tax on such a taxpayer's worldwide income, including foreign source income. So essentially, the foreign source income is getting taxed in the foreign country as well as in the residence country. Then it allows a credit or a deduction from its income tax for taxes paid in the foreign country. There are two methodologies of giving a deduction. One is called as a full credit method, and one is a proportionate credit method or a ordinary credit method. We follow the ordinary credit method. Under the full credit method, whatever taxes that you pay outside India, you get the tax credit in the residence country. Whereas under the ordinary credit method or the proportionate credit method, you get tax credit only to the extent of the tax payable in the residence country on the foreign source income. So to that extent, if you take an example, let us assume that we are paying about $100 of tax in the foreign country. The entire $100 of tax credit will be available in the case of a full credit method. Whereas under the proportionate credit method, assuming the tax on the foreign source income, because the tax rate in the residence country is lower than the tax rate in the foreign country, you will get a lower tax credit. That's the only difference. Majority of the countries follow the ordinary credit method. So here is where I want to ask the next question, which is essentially, is there not a conflict? Today, if you go back to the previous slides, which is essentially about section 5, is this not a misnomer? Because today we have seen that the global income is being taxed in India because of section 5(1), and you get a foreign tax credit. So to that extent, you are not paying any taxes on the foreign income. So what are we talking about? Worldwide taxation. So is this not something better for the tax regulation to be modified to what is applicable to non-residents, saying that don't pay taxes on worldwide, on foreign source income, because anyway you will get a credit. So is this not something which is applicable? Don't you see that there is a disconnect here between what the law and the practice of the law is? I'm asking a question. So don't you think that there is no worldwide taxation in this country? Anybody has a response? Why should we have worldwide taxation? Yeah, your mic, could you?
We pay tax in India on the total income, and we get a credit, ordinary credit.
Sorry?
Ordinary credit for the foreign tax.
Yeah.
That means we don't get the full credit, but we pay partial, we get partial credit. So we are paying tax on the global income.
No.
Yeah.
What I'm saying is, today let us assume that you have $1,000 of income outside India, on which there is a tax deduction of about $20, assuming there's a 20% withholding tax rate. So to that extent, when you include the $1,000 equivalent of income in the Indian tax return, you include that, and from the tax payable in India, you give a full credit of $20 equivalent, $200 equivalent to that extent of the
No.
credit that you have.
I don't think so, because what is the average tax payable in India? The average tax has to be taken. Suppose the average tax comes down to 15%, then we don't get that $20.
So let us
We
take
get only
let's take two instances. Let us assume the tax rate in India is 30% and the tax rate outside India is 20%. On $1,000 of income, what will be the tax that you pay outside India? You pay $2,200 worth of taxes. In India, what is the credit you will get?
Okay.
You will get $200 because the
$200.
tax rate outside India.
No, $200, you get it.
You get it in India.
You pay another 100 on the global income.
That is okay. I am saying only about India. Why should there be a worldwide taxation? Because I am required to pay taxes in India income. By including this, you are not getting additional tax.
It is
By including the foreign income, you are not paying additional tax.
I feel you are paying additional tax.
Where is it? You are paying
Let us
200.
say-
Wait.
No,
You are paying $200
let us say
outside
I've got
India.
a
You are getting
last-
credit of $200 in India.
No, you are not getting it. It is not exactly 200. You have to calculate the tax payable in India. What is tax attributable to the foreign income? If it comes to less than that, so to that extent, you are paying the tax on the global income.
That is fine. But at the end of the day, what I am saying is, you are not collecting any extra tax on that foreign income.
No, I didn't
On
get
that
it,
particular
because
taxation.
There's nothing like extra tax. See, you are paying tax outside India, you are paying in India. how much you get credit, balance is the tax payable
Are you,
and
so
other.
are you suggesting that you are going to get extra income by including worldwide income? Let me
Not
ask you.
extra
yes.
income. What I am saying is, there are chances which even I have dealt with corporates and individuals. So where, when the tax has to be, like take US taxation, what is the tax attributable to the total income? That much, to the extent you have included the foreign income, only you will get it. You will not get full. Same take you take in US taxation.
I'm not looking at that. I'm looking from a country perspective. Today, for instance, I am saying if there is a particular income which is included in my taxable income, which is foreign source income, first is I will calculate what is the tax payable on that income.
Correct.
I will give a credit only to that extent of tax payable on that income.
Correct.
So to that extent, whether I include it in the total income or I exclude it in the total income, the consequence is going to be the same, basically because I am going to pay taxes only on the domestic source income.
Okay.
So that is where so to that extent, by including a foreign source income, okay, it is only adding to the computation process. You are not going to get taxes on the foreign source income based on India. Because either you pay taxes at the India tax rate or at the foreign tax rate, whichever is lower. So you include something and you exclude the same amount of taxes which is there. The only instance where under the worldwide taxation you pay taxes is if you have an income outside India on which you have not paid taxes. That is the only income which is going to be taxable in India. It will not be to that extent a double taxation. If it is a double taxation, whatever income which is foreign income which is included is first included for computation. Correct. And you get a credit. So whether you include it or not in the computation or whether you exclude it or not, it makes no difference. The only difference is when you have an exempt income outside India, that will get included in the taxation, in the global taxation. That is the only difference to that extent.
So you mean to say that we are not paying any global tax at all?
No, we have not.
I mean, we are not paying any tax on the global income. We are paying. I'm including global outside countries' income here.
But you are getting a credit.
But credit is not equal to what tax I am paying.
No, you will get a credit to that extent of tax payable in India. You get credit.
If you get it.
Anyway, we will discuss this later
Okay,
to that extent.
thank you.
I don't want to. I just
No,
wanted to get a feedback of
This is
that.
a practical thing which I am handling today. That's why I'm asking you. Thank you.
Anyway,
You-
let's
when
discuss this
When
later.
you file the US taxation 1040, you get a 116 credit where it says tax attributable. Then the tax will be less than what we pay the tax in the credit.
Okay, we will discuss that later.
Thank you.
Now let us look at the foreign tax credit regime in India. You have section 90, which is the act which talks about TT exists. You get a bilateral relief, and section 91, as I mentioned earlier, it is a unilateral relief that you get. Under where you don't have a DTA, you get relief under section 91. Wherever there's a double taxation avoidance agreement, you get treaty relief to that extent. Now let us look briefly at what section 90 talks about. It basically gives granting of relief. That is the methodology, or that's the word that they have used. Income on which tax has been income on which tax has been paid under this act and under the act of the other country. Income tax chargeable under this act and under the corresponding law in force in that country. This particular section was introduced in 2004. The second subsection talks about avoidance of double taxation. This is the language which has been used in section 90. Avoidance of double taxation of income under this act and under the corresponding law in force. So essentially it says that wherever you are paying double taxation, you get a credit to that extent. Exchange of information for the prevention of evasion or avoidance of income tax. This basically was brought in because of the issues that we had in some of those countries where you had secrecy laws, particularly Switzerland, so we could not get details of that. So you have a mechanism to address that. Recovery of income taxes. Somebody who has to pay taxes in India, who goes outside India, so you have to recover taxes of that. So you will have mechanisms of providing relief. So there are 4 instances that they have given. Largely the first instance is where you pay income tax in both the countries. You pay income tax in both the countries and you get it. That is something that we will examine in greater detail. Now, this particular section gives overriding impact so far as the treaty is concerned. So if the provisions of this act shall not apply to that extent, they are more beneficial to the assessee. So if the DTA gives you any of the rules which is beneficial to the assessee, the rules of the DTA will apply. If the act is beneficial, you take the act whichever is beneficial, but this will not apply to GAR provisions. In substance, this is what Section 90 is all about. Now, Section 91 is also a very important section. It says basically if a tax resident earns foreign source income from a non-DTA country, for instance, Hong Kong, and has paid income tax in that country, has paid income tax on that country on that foreign source income, he or she shall be entitled to foreign tax credit in India at the income tax rate in India or the foreign country, whichever is lower. So it is essentially similar principles, except the language is a little different, so you will have some benefits. We will examine it a little more in detail later. So Section 90 and 91 gives you the mechanism of how to take foreign tax credit. Now there's explanations which has been given about what is the Indian income tax, how is it calculated and things like that. Now the next question that I have is, you know a mechanism of taking a foreign tax credit, you know what is a double tax. So can foreign tax credit be claimed against an income which is exempt in India? Essentially, if you see, there are three industries which largely take benefit of foreign tax credit. Before that, I just want to explain that foreign tax credit, will foreign tax credit apply to a parent or a subsidiary kind of a situation? This is the first question that I want to ask in this context. When there is a company, a parent company and a subsidiary company, can a subsidiary company, for instance, take, parent company, for instance, take credit in the residence country for the income generated outside India on which the subsidiary pays income tax? Can a parent company take foreign tax credit for the income generated by the subsidiary outside the residence country on which income tax has been paid in the foreign country? No. Why? Brilliant. So there are two different entities. Then in which case, what are we talking about foreign tax credit? Most of the entities work on a parent subsidiary situation. So where does a foreign tax credit then apply? Sorry? For dividend. No. Sorry? Branches. You are saying that? Brilliant. The only situation when we are talking about a foreign tax credit is when you have the same entity operating in two different countries. In the case of a dividend income, a subsidiary declares dividend income. Maybe it may have to pay taxes or it withholds taxes. The parent company gets the dividend income, and if there is a withholding, it gets a credit. The income generated by the subsidiary outside the parent company's residence country is not taxable, basically because not necessary that all the profit generated by the subsidiary is distributed as a dividend. It's only when they distribute that you have this double taxation to that extent. So the only situation where you will have a foreign tax credit, as we are talking about, is when an entity operates on a branch basis. Now in India, which are the entities which operate on a branch basis broadly? Sorry? Banks, brilliant. Other than that? Insurance companies, exactly. And then? I'm very disappointed. Sorry? Project office, okay. You are forgetting the industry that I have worked for the last part of my career. The software companies. They are the companies which operate largely on a branch basis. They also operate on a subsidiary basis for some instances. During my tenure at Infosys, I have established branches in 30 countries around the world. So the software industry operates on a branch basis. Banks operate largely on a branch basis, and insurance companies to that extent. So these are the entities which will have a double tax situation, and you will have a tax credit. So the question that I am asking now is, For a large part of my tenure at Infosys, it was not required to pay taxes either because of Section 80 HHE or because of 10A, 10B benefits. So do the taxes that I pay outside India eligible for a foreign tax credit in India? You're nodding your head, but I want an answer. One small suggestion. If somebody is sleeping next to you, please wake them and ask them, you please answer this question. So can somebody claim? So are you saying that you can't claim, you can claim? I want to know an answer. I want a good response. You can't claim a foreign tax credit against exempt income. Is that correct? Why? Sorry? So you are saying that you can't claim foreign tax credit in the residence country unless that income is doubly taxed. And because the income is exempt, it is not Tata Consultancy Services was listed. So till then it was a division of Tata Sons, and this was in the year 1999-2000. They paid federal income tax at 35%, which is the US tax rate. They paid about 35 crores and claimed tax credit. When you are talking about tax credit, basically it's a reduction of tax from the tax payable. It is not a reduction from the income in respect of taxes paid abroad. In addition, it claimed deduction of overseas income tax under Section 37(1), which is a deduction from the income, which gives the assessee a tax advantage of about 13.48 crores, being 38.5%. Which is the tax rate in India, which is 35% was the tax rate and 10% was the surcharge at that point in time. So they claimed a deduction. So they claimed a deduction as well as a credit of taxes. For payment of US federal income tax, not state income tax, just federal income tax of over 35 crores, the assessee claimed a tax relief of 48.49 crores. This is greed. Finally, the income which is subject to US federal income tax has not been taxed in India at all due to Section 80 HHE benefits because they took a deduction to that extent. So effectively, the US federal taxes paid by the assessee are sought to be offset on 1.38 times. I pay 100 rupees as taxes, I am claiming 1.38 times of 100 rupees, 138 rupees, I am claiming as a deduction from the Indian tax authorities. Finally, at the time when I have paid zero taxes. So the net effect that even though when there is admittedly no double taxation of an income, the assessee is able to reduce its income tax liability in respect of its other incomes. Basically, when you're talking about a proportionate tax, the difference between the proportionate tax credit and the full credit method is, under the full credit method, if the tax rate in the residence country is higher than the tax rate of the foreign source country, you are subsidizing. Essentially, you are paying the tax collected from the domestic income to pay the taxes of the foreign source income, because you don't have any. You have paid $100 of taxes there, and if your income tax that you are collecting in India relating to that particular income is only $75 equivalent, and under the full credit method, you are going to give them $100 of tax credit. So essentially, the $25 difference is something that you are going to pay out of the domestic income of that particular country, of that company. So that's the way it is. So essentially, here also, what they are saying is, in respect of that additional income tax that you are claiming, you are basically paying the taxes collected from the domestic income of that company. This is the facts of the case. So the CIT appeals, while holding that the assessee is entitled to deduction, they declined the claim of tax credit in respect of taxes paid in the USA, since there is no corresponding income tax liability in India. The assessee's point of view, which is the Tata Sons, said that taxes paid abroad are for the purposes of business and as such deductible under Section 37(1), which we will examine. Essentially, if you look at tax, can tax be taken as a deduction? As a principle of taxation, as a principle of accounting, can you take taxation as a deduction from income? Sorry? Why? It's incurred for the business, so you should be able to take a tax deduction. Okay. So essentially the principle is income tax is not a charge on income, it is an appropriation of income. That is the reason why you don't get a deduction for income taxes paid. Is that what you're saying? Okay. So taxes paid abroad, this is the contention of one of the biggest companies in India, which is the Tata Sons, paid abroad or paid for the purposes of business and as such deductible under section 37(1). We will examine 37(1). As an expense they have taken. The expression tax under section 243, which is the definition of the Indian income tax, covers only income tax chargeable under the provisions of this act, which is a brilliant argument. And as a corollary thereto, this limitation on deduction of tax does not extend to taxes paid other than under Income Tax Act. So what they are saying is, I agree, I will not take a deduction of taxes paid in India, I can take a deduction of taxes paid outside India. This is the argument given by Tata Sons. Now, if you look at section 37, which I'm sure all of you are aware about, it says any expenditure which has been laid out or expended wholly and exclusively for the purposes of business or profession shall be allowed in computing the income chargeable under that profits and gains of business or profession. Section 43 is very important. Let's look at this in greater detail. Tax in relation to the assessment year commencing on the first day of April 1965 and any subsequent assessment year means income tax chargeable under the provisions of this act, which is 1961 Act. And in relation to any other assessment year, they are including supercharge, and then after that, there is a particular fringe benefit tax which is included. So these are the definitions that we are looking at, which I am sure all of you are aware of. Let us also look at section 40A2. 40A2 basically says the following amount shall not be deducted in computing the income chargeable under the head profits and gains of business. Any sum paid on account of any rate or tax levied on the profits or gains of any business or profession. So this is what it says. So under all of these three sections, there is possibility of deduction is not there so far as tax is concerned. Is that correct? Is that what your understanding is also? Okay, so let us look at this particular decision for the deduction which has actually been taken by Tata Sons for the year 1999-2000. The ITAT observation says, Section 91 restricts double taxation relief only to such amount as may have been paid by the assessee in excess of its income tax obligations in India. This is the issue that we are talking about. Similarly, in terms of the provisions of tax treaties, which are entered into under Section 90, tax credits in respect of taxes paid abroad are restricted to assessee's domestic tax liability. As I said in the past, you have $100 of tax liability. If the tax liability in India is only $75, you will get credit only to that extent of $75. You won't get it for $100 in respect of the subject income, which is the foreign source income. The scheme of the Act, these are all the words of the ITAT, the scheme of the Act does not visualize this kind of an undue relief to the assessee, which provides much greater relief than the hardship caused to the assessee. The hardship is of double taxation. This is a very important para that they have used in the ruling. Is more than one tax jurisdiction, and the relief must not go beyond mitigating the hardship. It cannot be turned into an undue advantage or source of income to the assessee. When you are paid $138 equivalent outside India and you have paid zero taxes, essentially if you are asking for a credit, the tribunal is saying you are generally asking for an income of $138 from the government of India. That is not fair. That is what is the summary of this particular judgment. There was a subordinate appeal, so they accepted that, but they said you should allow a deduction of taxes. Whatever taxes that are paid outside India, particularly in the United States, you have a federal tax and the state taxes. Unlike in India, where you only have a federal tax, there you have both federal and state taxes. And the US-India tax treaty does not cover state taxes for credit, it only covers the federal taxes for credit. So in this case, they appealed saying that we should be allowed to take a deduction for the state taxes, state income taxes that we have paid, because relief is not there under Section 90 for that. So the IT-80 says the state income tax is also covered by the explanation 1 to section 48(2), and deduction cannot be allowed in respect of the same. And then there was a judgment in the case of Gill's case, income tax paid abroad cannot be allowed as a deduction in computation of income, and this judgment does not discriminate between federal and state taxes. So you cannot take a federal income tax deduction in India, you cannot take a state income tax deduction in India to that extent. So for all of these reasons, we are unable to uphold the plea of the assessee seeking deduction of at least state income tax paid in USA. This ruling was given in 2010, November 2010. And this ruling, one of the members of this panel, IT-80, was Mr. Pradeep Kumar, who is one of those few IT-80 members. He retired as a vice president of the IT-80, who had a very good understanding of international tax. In one of the similar instances in the case of Tata Sons itself, which I have not covered here, he gave a ruling saying that state income taxes you cannot take a credit because it is not allowed under the treaty, so you cannot take a credit to that extent. He withdrew that particular ruling, and then he gave another ruling suo moto saying that you cannot be put to a disadvantage between a treaty and a non-treaty. If you are covered under section 91, you can take state income tax also as a credit, whereas if you are covered under the DTA and the DTA does not permit, then you are not getting. Whereas section 90 says that you should be given the benefit under the Income Tax Act or the treaty, whichever is beneficial, and one portion of the Income Tax Act gives credit to a tax payer who has paid taxes, state taxes, for instance, in a country where there is a state tax payable. So there is a discrimination. So he said you should be allowed to take state tax credit even if the DTA does not permit under the section 91, because section 91 does not cover, section 90 does not cover. The DTA will not extend to state taxes, income taxes paid, so it will get covered under section 91. That was another ruling which Mr. Pramod Kumar has given. So this is the ruling. So essentially, whatever you people are saying that you should not be entitled to take tax credit for foreign taxes paid outside India when you are tax exempt India is what this ruling is saying. Is that correct? So let us look at one more ruling, which is another peer company. This is the Karnataka High Court judgment in the case of Wipro Limited. Wipro Limited also, like Infosys and TCS, operates in many countries outside India on a branch basis. Now, facts of the case, Wipro is engaged in the business of export of it's a software services company. They also have other businesses, but largely it is there. They also have operations in around the world like Infosys and TCS. It computes profits attributable to this PE outside India, and they pay the appropriate taxes in those foreign jurisdiction. Wipro is also eligible to tax holidays just like Infosys or TCS. They were getting benefit under section 80 HHE as well as under section 10A, 10B, whatever it is. So the issue is whether foreign tax credit can be claimed in India, same issue in relation to income eligible for deduction under section 10A, which is exempt income. The years of assessment here also is similar to what TCS is. TCS claimed in 1999, 2000. Here they are also claiming for 4 years to that extent. It also, like TCS in the previous example, made a claim for tax relief against state taxes paid in USA and Canada. So let us see whether this is a High Court judgment, whether this High Court judgment is something similar to TCS. Ideally, it should be. So the contention of the IT department says section 80A, which is appearing under chapter 3, it refers to income which do not form part of the total income. You get a deduction from the total income to that extent of profits generated from 10A units. Income tax is neither paid nor incurred in India in respect of the income. This is the contention of the department. Income tax is neither paid nor incurred in India in respect of the income of the unit qualifying for deduction under section 10A. Thus, foreign tax credit under section 90 does not arise. The company said, with effect from 2004, clause A2 was substituted under section 90 to provide for entering into an agreement for granting relief in respect of income tax chargeable under this act and under corresponding law in force in that country to promote mutual relations, economic relations, trade and investment. With this amendment, the power of the central government has been greatly widened. This is the contention of the company, and it can now enter into an agreement, and not only for avoidance of double taxation, but also for granting relief for tax-exempt income. This has been the contention of the company. Therefore, payment of income tax in both jurisdictions is not mandatory anymore for granting the relief. Till now, we have looked at foreign tax credit saying that you are eligible for credit only if there is a tax liability in both the countries. If you have not paid tax in one country, you are not eligible for tax credit to that extent, either in the residence country or in the foreign country. You don't pay taxes outside India, you can't claim a credit. If you have not paying taxes in the residence country, you can't claim credit. Whereas this company is saying that it is not mandatory anymore because of this amendment in section 90, 1A2. Let us look at this particular provision to say whether it is true or not. The Income Tax Appellate Tribunal, which is the first layer, they refused to give foreign tax credit because they said that they are not liable to pay tax due to the exemption similar to the ruling which was given in the Tata Sons ruling. So the tribunal rulings are similar. The Karnataka High Court, in the case of Wipro Limited, okay, so let us look at this particular section before we go to the ruling. So this is what we have covered earlier also. It is there in the presentation slides. The central government may enter into an agreement with the government of any country outside India or specified territory outside India for the granting of relief, which is basically a tax credit, in respect of income tax chargeable under this act. It doesn't use the word pay. It is chargeable under this act and under the corresponding law in force in that country or specified territory, as the case may be, to promote mutual economic relations, trade and investment. This is the method, this is the language that they have used, which was modified in 2004, based on which the company is claiming that I don't necessarily have to pay income tax as a underlying tax to claim a credit. So let us look at what the Karnataka High Court has said in the case of this case. The Finance Act 2003 extended the benefit of granting double tax relief to income tax chargeable under this act. Therefore, the payment of income tax in both jurisdictions is not compulsory anymore. This is reiterated by the Karnataka High Court. Section 10A provides for deduction of profits or gains from the export by an undertaking for a period of 10 years. The profits and gains derived by such undertaking would form part of the income. So it is included in the income, so you can't say that it is not taxable. It is included in the taxable income. And you get a deduction to that extent. Under section 4 and 5 it is included. When an assessee is having several undertakings, one of which falls under section 10A, the assessee's entire income from all the undertakings is computed to arrive at the total income. However, the income from such undertaking falling under section 10A is deducted, which is the methodology of section 10A, is deducted from the total income. The said exemption has the effect of suspending income tax collection for 10 years and stands revoked after that period. Therefore, this case falls under section 91A2. This is the observation of the Karnataka High Court. Before this, when the assessee, when the company made the contention, they had said that the income from such undertaking did not this. Okay, here if you see the company, they said that the amendment, the power of the central government has been greatly widened. It can enter into an agreement not only for avoidance of double taxation, but also for granting relief of tax exempt income. In fact, I went through the memorandum to the Finance Bill of 2003. And I said that whether there is any such inference saying that you can claim a double tax credit for an exempt income, and nowhere did I find any of this language which they have used to substantiate or to make a claim for claiming tax credit. You also can go and look at the memorandum of the 2003. The budget speech does not talk about this. The memorandum does not talk about it. And this is the observation of the ruling. Now, when an exemption is given under this act, this is what the Karnataka High Court is saying, is given and the said income is taxed in foreign jurisdiction, there is no relief to the assessee at all. Therefore, to promote mutual economic relations, trade and investment, the act was amended by Finance Act 2003. The statute by itself is not granting relief, but by virtue of the statute, if an agreement is entered into to provide any such relief, the assessee would be entitled to such relief. My observation is, you are claiming credit under the double tax avoidance agreement, which was entered into in 1989. At that time, there was no such thing as economic relations and trade. To my mind, this kind of an agreement is basically, and Wipro is not making a claim saying that India has entered into an economic trade agreement and under that agreement this is provided. There is no such agreement which is there. So to that extent, while the Karnataka High Court is claiming so, I have my own doubts about it, but of course we have to go by the judgment to that extent. So this is where so you have an instance where whatever we talked about is being reversed by this judgment. What did we talk about? We said if there is a double taxation, you can get a credit. Only if there is a double taxation. Now in this particular instance, even though there is no double taxation, there is a relief being granted to this company basically because of the language which is used in the Income Tax Act. So basically maybe we have to fault the drafting of that particular legislation to get this undue benefit. That's the way I would look at it. So you have examined an instance where the Mumbai Tribunal have refused a credit to Tata Sons, which is Tata Consultancy, whereas a similar refusal was given by the tribunal in Bangalore, but the Karnataka High Court has reversed to that extent. However, this does not end the matter here. The Karnataka High Court ruling is not absolute. It again has to be read in the light of relevant treaty. Article 23 of the Indo-Canada Double Tax Avoidance Agreement provides the following. Let us look at the treaty, whether this can be universally applied. That means essentially what we are saying is, at the end of the day, whatever foreign income tax that you pay, you get a credit in India based on this ruling. Essentially, whether it is exempt, non-exempt, whatever it is, you can claim entire credit. So to that extent, it is not even ordinary tax credit, it's a full tax credit to that extent. Because when you are getting a tax credit, when you have not paid any income tax, it's a full tax credit. So even to that extent, we can extend this logic even to instances where you get a full tax credit, not an ordinary tax credit. So that is what the substance of this is. But let us look at the treaty, specific treaties. Let us look at particularly the Canada treaty and the US treaty. US treaty is important basically because the largest source of income, particularly for the software industry, comes from the United States. Now, if you look at this Article 23, it says, in case of India, double taxation shall be awarded as follows. The amount of Canadian tax paid, I am emphasizing Canadian tax paid under the laws of Canada and in accordance with the provisions of the agreement, whether directly or by direction, by a resident of India in respect of income from sources within Canada, which has been subject to tax both in India and Canada. For the sake of this presentation, I have substituted the words India and Canada wherever it is necessary. So essentially what this agreement says that in respect of income from sources within Canada, which has been subjected to tax both in India and Canada, it shall be allowed as a credit against the Indian income tax payable in respect of such income, but in an amount not exceeding that proportion of Indian tax with such income based to the entire income chargeable to Indian tax, which is basically a proportionate credit method. So this particular treaty says you can take a tax credit in India only if income tax has been paid in Canada and in India on that income. So to that extent, this ruling will not apply in the case of this particular income that you generate from Canada. That can also be debatable because you have section 90 which says whichever is beneficial, but let's leave that aside. So the benefit under Article 23 of the Indo-Canada TTA will be available to an assessee in India only if the assessee has paid tax both in India and Canada. As a corollary, if the assessee is exempt from payment of tax in India and if the same income is subject to tax in Canada, according to the treaty, there is no double taxation. Now let us look at the similar provisions under the India-US treaty. Article 25, in this case, it says relief from double taxation. So if you see the wordings, Article 25 talks about relief from double taxation, whereas if you see Article 23 of the Indo-Canada Treaty, it is the elimination of double taxation. Now, 23 says, does not impose a condition that income tax must be paid by the Indian tax resident in India for claiming the foreign tax credit. So they don't have the language which is used similarly in Canada Treaty. So 25(2)(a)(2) says, where a resident of India, again I modified it to suit this particular presentation, where a resident of India derives income which, in accordance with the provisions of this convention, may be taxed in the United States, India shall allow as a deduction from the tax on the income of that resident. It doesn't say tax paid, it only says tax. So the moment you talk about tax, then the interpretation will be tax chargeable need not necessarily paid if you go back to section 91(a)(2). An amount equal to the income tax paid in the United States, whether directly or by deduction. Such deduction shall not, however, exceed, which is the proportionate credit method. So this is essentially the substance of treaty. Canada treaty does not permit, US treaty, we have to look at various other country treaties to see whether most of the countries don't have the kind of a requirement of payment of taxes, but we have to examine each of that. So essentially the Karnataka High Court decision permits companies which are exempt from paying taxes in India to claim foreign tax credit. So you have two divergent views in this particular case, which all of us in this particular auditorium believe should not be eligible for taxes. Is that okay? Any questions? No, they have not. Sad. This is the next question I have, which is a practical question. I am not asking something which is exotic. These are all practical questions. Can a company claim foreign tax credit when it has filed a loss? It is not exempt. It has incurred losses. So I operate around the world. In some countries I pay taxes, in some countries I don't pay taxes because of the economics of that particular business. So in India, the parent company or the base company has suffered losses. So can I claim a double tax credit in India? I want an answer, otherwise I think all of you are sleeping. A company can claim foreign tax credit when it has filed a loss return. Is that what you are saying, or it cannot claim? It can claim. It can claim foreign tax credit in India. So there is somebody who is saying it cannot claim, there is somebody who is saying it can claim. So can we have a raise of hands to say which is the majority view? Let us have some fun. I want an answer. Can claim, you have a large majority. Cannot claim? Okay, so you still have a minority. Why do you think you cannot claim? Let me ask you that question. Brilliant. Why do you think we can claim? There is a large majority which says you can claim. So on what basis do you think we can claim? I'm just asking you. You can give your views. It's okay. There's a lady who has given a brilliant answer. I expect a brilliant answer from that side also. Incidentally, all the people who have raised hands saying they cannot claim are in this side, and the people who are saying can claim is in that side. That's incidental. But anyway, you please say whatever you want to say. Okay. So you are asking the government of India to refund that amount because you have a loss situation. Income includes loss, so you can claim a credit. Brilliant. So with this, we will go ahead and see what is this issue. So we have looked at two instances of software companies. One is Tata Sons, which is Tata Consultancy, and one is Wipro. This is one of the people who talked about the first instance of foreign tax credit for banks. So this is a situation where there is a public sector bank which has claimed, and majority of the banks around the world operate on a branch basis. So this is the second industry which is suffering some consequences of foreign tax credit. We have time still, about half an hour? Okay. So this is the background. Bank of India earned business profits from its branches outside India in about a dozen countries. This was in the year 2011-12 financial year. The assessee bank paid income tax aggregating 166 crores in treaty partner jurisdictions and about 16 crores in non-treaty partner jurisdictions. So they have operations both where there is a treaty and where there is no treaty. So they have a combination of section 90 and 91. Income tax of 87.55 lakhs was withheld from the foreign dividend received by the bank. In addition, the bank received dividend from its subsidiaries, not from the branches. So there has been a certain amount of tax which has been withheld outside that country. So there are three sources of income and tax. Tax income from partner countries where there is a tax withholding or there is a tax payment. There is a tax payment in countries where there is no DTA. The third one is there is a dividend income received by the bank on which taxes have been withheld. These are the three situations which is covered in this particular case. The computation of the global assessee's global income, which is taxable in India, resulted in a net loss. Net loss, that is after all the profits and losses of all its entities, of 191.39 crores. We will see how this 191.39 crores was arrived. Since the assessee does not have India tax liability on the profits earned abroad, it was not given any credit for the taxes paid abroad. This is what one section of the audience is saying, they should not be given credit. So that was what has happened. Similar to the situation that we talked about the two previous instances, saying that exempt income, no tax liability, so you don't get credit. Similarly here, you are not paying a tax in India, so to that extent you don't get credit. That is the sum of substance. So the issue is whether an Indian taxpayer can claim refunds, which is what this lady talked about, can claim refunds from the government of India for taxes paid outside India when it has filed a loss return in India. This is the crux of the matter. So the contention of the assessee, this is a case which has come in 2015, if you see. This was March 21. So if you see, there already was a 2015 Karnataka High Court judgment. So they have gone on that basis, referring to the Karnataka High Court judgment decision in Wipro Limited, that even though the income in question of the assessee was exempt from tax in India, the assessee was entitled to tax credit in respect of taxes paid abroad on the foreign income. So essentially what they are saying, there is a ruling which has already been given by the Karnataka High Court, which says that payment of taxes is not compulsory, to that extent. So under the circumstances, I am not paying taxes in India because I am having a tax loss, but I should be given a credit similar to the judgment which has been given by the Karnataka High Court. This is a simple argument which has been made by the bank. Now, payment of tax in the residence jurisdiction is not a condition precedent, which is what was ruled by the Karnataka High Court for taking benefit of foreign tax credits because of section 91A2. In effect, taxes once pays abroad for all practical purposes can indeed be refunded in India. So essentially what they're saying is whatever I have talked for the past 1 hour is a waste of time, because they're saying whatever you pay tax outside India, you claim a credit. This is what the judgment is. Okay? So all of us have wasted our time. You people, instead of sleeping, you listen to me and then you lost your sleep also. Let us look at the ITAT's observation here. Incidentally, this ITAT also had Mr. Pramod Kumar as the member of that particular judgment. So let us see what this ITAT has talked about, similar to the judgment given in the first instance of Tata Sons, where Mr. Pramod Kumar also was a member. It says, the provisions of section 91A2 cannot be interpreted to mean grant of refund by the Indian authorities to the assessee for taxes paid by such assessee outside India under the situation when there is no tax payable by the assessee in India. Essentially what this lady talked about, you can't claim for a refund. You have not paid, you can't claim for a refund. So the assessee said, the foreign source income, this is a brilliant argument, which is a practical issue. The foreign source income is included in the total income in India. Thus, it has reduced the losses carried forward, and to that extent, it has suffered income tax in India, which is a matter of fact. Today, when you have a carry forward losses, you only carry forward net losses. You don't carry forward the losses incurred in those countries where there is an actual loss, and then you pay a tax to that extent of profits incurred in some countries. It's a net liability because it's the income of that entity of all its activities. So whatever profits you have earned in jurisdictions and whatever losses you have earned in jurisdictions, it is offset, and the net income or the net losses is carried forward for X number of years, whichever is allowed. Is that correct? So this is what is the content. So indirectly I am paying taxes in India because you have reduced the amount of losses that I can carry forward. The assessee is being subjected to double jeopardy since the assessee has been declined tax credit. You are not giving me tax credit, and correspondingly my loss is being carried forward is also reduced. You are not giving me tax credit, you are not increasing the tax losses to be carried forward to that extent. So I am getting a double jeopardy. Basically, I am suffering on two counts. As against a business loss, how did we get that 191 crore? It says as against a business loss of 826.58 crores, what is being allowed to be carried forward for set-off is only 191 crores, since the foreign profits of 635 crores are offset against the same. So essentially, you have paid taxes in India and outside India on 635 crores because you've reduced that amount of profits to be carried forward to that extent. Such jeopardy will be absolutely unjust and inequitable. This is the argument which has been given. Anything wrong in what this assessee says? So let us look at the ruling, which is again it's a good ruling, I would say. Let us look at that. So it says subject to tax in India means that income in question should be subjected to Indian tax laws, whether or not there is any actual liability to tax. This is what it is. So this is the contention made by them, saying that whether I pay taxes in India is not the issue. Similar to the argument given by Wipro, it should be subjected to tax. Because it is chargeable to tax, subject to tax, I should be given a refund of the amount of taxes paid. Otherwise, you reduce the amount of carry forward losses, increase the amount of carry forward losses. So let's look at the observations of the IT80. It's very important. Let's look at this. The IT80 refers to various judgments. They have referred to almost about half a dozen cases in this particular case, which I have not quoted here for lack of space and time. Refers to various judgments both in and outside India to explain the difference between liable to tax and subject to tax. These are all things that we could not have imagined to that extent, and that is the reason why I have chosen to take this particular case law. There are about half a dozen case law. They are referring only to highlight what is the difference between liable to tax and subject to tax, because this is one of the grounds of appeal. In particular, referring to the AR decision in General Electric Pension Trust, IT80 says it is worth pointing out that the phrase liable to tax and the phrase subject to tax are not synonymous. If both were read to be synonymous, then Proviso B would be otious, whereas Provision 1 talks about being in the tax net, Proviso B talks about actual taxation. So there is a difference between liable to tax and subject to tax. In one particular case, it says being in the tax net. Other one is taking that actual liability being discharged. This is the first instance that they are talking about. Secondly, they are saying we are of the considered view that the income earned by the assessee in the UK cannot be said to be subjected to tax in India. So essentially what the assessee is saying, Bank of India is saying is, I have earned income outside India in one country. So finally there is a loss in India, so you should offset. The ITAT says, while it did indeed suffer taxation in the UK, as the assessee did not have any taxable income in India, this income was offset against the losses incurred by the assessee outside of the UK. We don't know the facts. We do not know in how many countries they have earned profits, how many countries they have earned losses. So essentially what the tribunal is saying is, whatever profits you have earned outside India is offset by the losses incurred outside India, so you are not getting a tax credit. This is one of the arguments. This income was offset against the losses incurred by the assessee outside of UK. The income so earned in UK was never subjected to tax in India, meaning non-payment of tax in India, because it is offset there. So you can't claim saying that I have paid taxes indirectly, because you're saying it's being offset there. We do not know the mechanics of that, so we will leave it there. On double jeopardy, it says, in case the assessee does not make any profits during the period eligible for set-off, there cannot be any double jeopardy. Therefore, the so-called jeopardy, as in the present case, nothing more than a mere possibility in the realm of an accounting contingent event. The taxation reliefs cannot be on the basis of possibilities. This is a big statement that they have made. Let's look at the next para. The taxpayer can nevertheless, on the grounds of equity and double disadvantage. Essentially they are saying is, you have a double jeopardy, basically means you have double disadvantage. You are not getting a refund of taxes, and then your losses is also getting reduced to that extent. So to that extent, they release double disadvantage, can claim those tax credits in the year in which the taxpayer is actually subject to a higher burden on account of reduced eligible set-off of losses carried forward. This perhaps remains an open issue for adjudication. They are saying that yes, you have a point saying that you have a double disadvantage that needs to be addressed at the time when you have a higher tax liability, when the losses are over and it gets subject to taxation to that extent in the year in which you become profitable. Now, it also makes an observation on Wipro High Court ruling saying the amount of FTCC claimed was substantially less than the Indian tax liability. For example, in the year assessment year 2003-04, the returned income of Wipro was 164.86 crores and the foreign tax credit was only 21 crores. So basically what they are saying is in the case of Wipro, while they got a credit, there was no refund because the amount of claim that they made of foreign tax credit was offset against the income that you had, which is higher than the claim of credit. None of the situations dealt with in the said order was to result in a refund. So in the case of Wipro, they are saying there was no refund. There was a lower amount of taxes paid, whereas in your case, you are asking for a refund, so it is not comparable. The inference that the situation envisaged in the Wipro decision can also result in a refund situation of the taxes paid abroad is neither dealt with by the said decision nor implicit from the conclusions arrived therein. So this is a very important point they are saying. In the case of Wipro, they did not ask for a refund, you are asking for a refund, so it is not similar. Next, the ordinary meanings given to the expression foreign tax credit does not visualize the possibility of refund of taxes paid in the source jurisdiction by the resident jurisdiction. So this is the ruling that they have observed. Also, it is noteworthy that the heading of Article 25 is elimination of double taxation, but then there has to be double taxation of an income in the first place before the question of elimination of double taxation. If all the arguments made by the ITAT in this particular case was applied by the Karnataka High Court in its judgment, the judgment would have been different. So that is where I want to highlight, saying that look at the way in this particular case this credit is being denied, and if you had applied the same arguments, what would have happened in the case of Wipro? So it says, in the case before us, the assessee has paid taxes in respect of that earning only in one country, United States, and claimed losses on account of admissible deductions. This is not a case of double taxation, essentially. On income from non-treaty jurisdictions, plain reading of the statute says that double taxation of income is a condition precedent for this relief, because the relief is granted only with respect to such doubly taxed income. This is all the emphasis that I am giving to say why they have denied this credit. Now there was another claim which was made, similar to what was made in the earlier instances, saying, okay, you are not giving me credit, will you give me a deduction from income?
So this is the claim, whether or not the assessee is eligible for a deduction being taxes paid abroad on his income for which the assessee has not been granted any tax credit. Claim for deduction of taxes paid abroad. ITAT observation saying that we find this squarely covered in favor of the assessee by a judgment of a jurisdictional high court in the case of Reliance Infrastructure. So to that extent, they are quoting this particular jurisdiction saying that they should be eligible for a credit of state income taxes. Now earlier we said state income taxes or any income tax you cannot claim a deduction because it is a charge on profit. It is not a charge on profit, it's an appropriation of profit. In this case they are saying you are eligible to take a deduction. So let us see what this ruling says. We noticed that the decision of this court in Inder Singh Gill, which was an earlier case, was rendered under the Indian Income Tax Act 1922 and not under the Act. This is also a very interesting ruling. It says they are referring to two Income Tax Acts, 1961 and the Income Tax Act before that. We further note that as Section 48(2) of the Income Tax Act does not allow deduction on tax paid on profit and on gain on business, the Indian Income Tax Act 1922 also contains a similar provision. So essentially what they are saying is you have 48(2) in Income Tax Act 1961. You have a similar provision, Section 10(4) under the 1922 Act. These two are similar to that extent. Now, under both these acts, whether income tax is deductible or not is something they are examining. The Indian Income Tax Act 1922 contains no definition of tax. Whereas here we have seen a definition of what the tax is, there is no definition of tax as provided in Section 243. We looked at Section 243 of the 1961 Act, there is a definition of tax. Whereas there was not a similar definition of tax there. So to that extent, what they are saying is, under the 1922 Act, you can't claim a deduction for any tax paid anywhere in the world. That is under the 1922 Act. Under the 1961 Act, Section 243, you can refer to the definition of tax, there is a particular definition of tax. Now you can claim a deduction for taxes paid outside India because this particular definition talks about tax payable under the Income Tax Act 1961, which is tax payable in India. So taxes, income tax that you have paid outside India, you should be eligible to take a credit because it does not refer to taxes paid under the Income Tax Act 1961, but it refers to the domestic taxes paid in those jurisdictions. On that basis, this particular tribunal says you are eligible to take a credit to that extent. So this is what the ruling is all about. So the ITAT's concluding remark in this case is, as some people pointed out here, saying they should not be eligible to take a tax credit. The assessees declined foreign tax credit for 182.64 crores. Accordingly, we hold that the assessee is not entitled to seek a refund of that money from the Indian tax exchequer. We have our reservations on the applicability of the Wipro decision in this case because of jurisdiction. We are also of the considered view that full tax credit for source taxation cannot be extended in the residence jurisdiction when a tax treaty sanctions only proportionate credit and does not in any case specifically provide for the full foreign tax credit. We uphold the claim of the assessee that taxes paid abroad will be allowed as a deduction in the computation of business income of the assessee. This is the final conclusion of the ITAT tribunal. Any comments that you have? Mumbai IT. Okay. Since there are no much comments, I will go to the last question. This law situation is something which can happen around the world. And you have multinational companies which incur losses. So the question that comes to my mind is this situation unique to India or do other countries face a similar situation? What do you think? Do you think this is unique to India or this must be there in all the countries in the world? What is your view? It must be there. Who said that? No, who said must be there? So you are saying that this situation is not something unique to India, it must be common around the world. Is that the Consensus, please wake up the people sleeping next to you. I want a louder answer. I am the only guy who's shouting here, please. It is not unique to India. Huh? Okay. I disagree. Let's look at that. See, this is a very important observation that the ITAT talked about. It says the taxpayer can nevertheless, on the grounds of equity and double disadvantage, claim those tax credits in the year in which the taxpayer is actually subjected to a higher tax burden on account of reduced eligible set-off of losses carried forward. This perhaps remain an open issue for adjudication. What basically this tribunal is saying is, while you have a double disadvantage, you have to address this at the time when your losses is offset and you are liable to pay taxes. See if you can make a claim at that point in time. This is the sum and substance of this particular thing. How is this possible is the question that I want. What is your understanding of this particular case, which is a brilliant case for all of you to understand? Why do you think this kind of a situation arises? Sorry? How will you take credit when you have income? Because they have declined, no? At that time, how can you make a claim? Because you don't have. So how will you show it? What you're saying is correct. This is what they're saying. How will you take the credit? How will you show it? You have come close to the issue. What you're saying is true. I want you to elaborate a little bit more. I can do it, but I want you to do it. They are not saying that, the law is saying that. See, the sum and substance of this, as he rightly said, is about timing. Today we have a situation where, this is basically where you have a carry forward of business losses, which is okay. But you don't have, as he rightly says, you don't have a carry forward of FTC. Today, this is a carry, this is a loss, FTC. You should be allowed carry forward of taxes. Let us look at what, to answer your question, I said about the law, let us look at the foreign tax credit rules, which has been drafted in 2017. This case is something which is after that. Foreign tax credit rules which came in 2017. Clause 5 of the foreign tax credit rules states the following. This is precisely the issue that you talked about. You please see this. Foreign tax credit shall be the aggregate of the amounts of credit computed separately for each source of income arising from a particular country. Essentially, they are saying foreign tax credit in this country should be computed source by source, country by country. You can't merge. Okay? And shall be given effect to in the following manner. The credit shall be the lower of the tax payable under the Act on such income and the foreign tax paid on such income, which is the proportionate credit method that we have been talking for the past 1 hour. Where the foreign tax paid exceeds the amount of tax payable in accordance with the provisions of the DTAA, such excess shall be ignored. So to answer your question, you cannot claim tax credit at the time when you become payable because it's expired. Essentially what he's saying is, you carry forward losses, but you can't carry forward foreign tax credit. That's a mismatch. No, this is not jurisdiction law, it's the Indian tax law. You are saying that if you are not, if you have got excess, see, essentially what this means is excess tax credit this is. You have got the amount of taxes paid, which is a fact. That tax is eligible for foreign tax credit, which is a fact. You would have got the tax credit if you had paid taxes in India to that extent, which is a fact. Because you don't have taxable income, you have a taxable credit.
You don't have an income against which you can pay, you can offset that and taxes against that. So this is excess tax credit. This excess tax credit you are not taking forward. Ideally, if you are taking forward this tax credit, in the year in which you become taxable, you claim a credit in that year. So let us assume that after 5 years, they become profitable all over the world. In that year, you can claim a credit. You can't claim credit because of this particular section or this rule. Okay? So, this is where the issue is. Carry forward of excess foreign tax paid. Companies that do not receive full credits for taxes paid in foreign countries, the language which is used in international tax is excess credits. Excess credits arise because of the following situations. If a multinational company is carrying on business in a portfolio of countries where the income tax rate is higher than the income tax rate in the residence country, or has incurred losses in the residence country. So, for instance, you have paid taxes of 35% outside India, assuming the tax rate in India is 30%, you forego that 5%, which is correct under the foreign tax credit rules. Similarly, you can carry forward the taxes because if you are operating in a portfolio of countries, see if you go back to the rule, it says source by source, country by country. When you are operating in a multitude of countries, you will have different tax rates ranging from 10% to 30%, 40%. Okay? So under these circumstances, you are not offsetting the rates that you have outside India. You have to carry forward. So for each country, each source of income, for capital gain, you have to calculate separately. For business income, you have to calculate separately. For dividend, you have to calculate separately and then do this entire thing. And wherever that excess credits are there, it is foregone. So multinational company carrying on business in a portfolio of countries where the income tax rate is higher than the income tax rate in the residence country or has incurred losses in the residence country, excess tax credits arise. If the ratio of high tax income or the ratio of income from high tax portfolio of high tax countries during a financial year is high. So for instance, you take a classic example of the United States. At one point in time, they had 35% tax. In one single year, they reduced the corporate tax rate by 14%. There's no other country in this century who has done that, reducing the corporate income tax rate by 14%. So the composition of the tax that you operate in the countries can undergo changes to that extent. Or payment of branch profit tax. Branch profit tax is a concept which is there in the United States. When companies like Infosys operates there, we pay branch profit taxes, which is the equivalent of dividend taxes. In the case of subsidiary parent relationship, you pay dividends and you pay taxes on dividends. Whereas in the case of withholding tax on dividends, whereas in the case of branches, whatever the excess taxes, excess profits that you generate, which is payable to the parent company, you have a branch profit tax. There's a computation of branch profit tax. And branch profit tax need not arise every year because of the computation. It can arise once in 5 years, 10 years. So in those circumstances, you will have a higher federal tax rate to that extent. So you will have an excess credit there. Many countries permit carry back and carry forward of taxes. That is the reason why I asked, is this unique to India? This is unique to India because all other countries permit this. So let us look at those countries which permit this. Canada, I have gone in the alphabetical order. Canada, carry forward of 10 years, carry back. Carry back as a concept doesn't exist in India, even for income tax to that extent, whereas carry back exists in many countries. If you have a tax refund to that extent, you can offset it either against the previous year's income or against the future years. So you have Japan, carry forward for 3 years, carry back for 3 years. Singapore, there's no limit for carry forward. All the excess tax credits over a period of time you can take. No limit for carry forward, carry back for 3 years. United States, carry forward for 10 years, carry back for 1 year. So many of these countries don't face the situation, companies in those countries face the situation, particularly because of carry back and carry forward of excess tax credit, unlike in India, where those countries have carry back and carry forward of business losses and foreign tax credit. In India, it is only carry forward of business losses. You don't have a proportionate carry forward of excess tax credits to that extent, and that is where the problem lies. It was about 2012 that I made a submission to the government of India even before they knew what foreign tax credit is. In that submission, which was running to about 30 pages, which I covered many instances, one of the suggestions that I had made in that submission was to carry forward of excess credits for 10 years so that Indian companies can take credit in future years if the revenue from the portfolio of those countries changes. To that extent, if the operating countries have lower tax liability compared to the earlier years, you will be able to take a excess tax credit to that extent. If an Indian company is unable to take tax credit, which is a fact in many of the countries, they should be given the choice to take a deduction in the last year where they are not able to offset those losses. But as usual, the government ignored this. So if you essentially see, the companies which are suffering because of these foreign tax regulations is because of bad tax planning or regulations which do not permit this. Even after this ruling, there has been no attempt made by the government of India to permit a carry forward of tax losses to that extent, for foreign tax credit to that extent, because this may be a recurring problem for many of the banks. And they're all, incidentally, this is a public sector bank, regardless of whether it is a public sector bank or not. At the end of the day, this is the way the world operates in terms of foreign tax credit, and that should be considered. Whereas if you see, one company got the benefit because of a ruling which was, to my mind, inappropriate, but I'm nobody to comment on that. So the issue, to my mind, is foreign tax credit is not something which has been understood by the tax officials who are in charge. They come back with a view saying that the amount of foreign tax credit is a very small proportion. There are many other issues that we need to address to that extent. So to that extent, whether this is going to be a recurring problem, we don't know till such time. It will be a recurring problem till such time they introduce a regulation relating to carry forward of excess tax credits. So far as credit of foreign taxes against exempt income, there is already a precedent in terms of a Karnataka High Court ruling, unless it is challenged in some other High Court to that extent, that issue remains. So with this, I come to the conclusion of my presentation. Thank you very much. If you have any questions, you can please ask me. Yeah.
Generally, outside India, it's calendar year, and in India, it's financial year.
Sorry?
Outside India, it's generally calendar year.
Correct.
And
You have a
inside-
challenge there.
Yeah. So, at times, what happens that in the month of March, late March, I build outside India, and since, as per the Indian provisions, I offered that income for taxation in India in March itself. But I never know when the withholding actually happened. So in that case, generally we take a stand that since the income is offered in this particular year, let's claim FTC, because by that time, filing return in October, November, the person knows that what was the FTC amount. So what is the correct provision?
There's no provision because the foreign tax credit rules do not address this. The Act does not address this. So this is a practical situation. So to that extent, in the year in which you have a larger portion of that overlapping year, I think it's better to take in that year. And do it consistently.
Yeah.
Okay, so that's very important because at the end of the day, if you take it consistently over a period of time, the tax authorities will be able to understand saying that you are claiming that income. You take the credit in the year in which it is offered in the foreign country. But then there will be an overlap to the extent of a small portion. Say, supposing, let us assume that you have earned income all through the year and you don't know what is the foreign, in the case of withholding, you will know what is the amount of tax withheld on a period-to-period basis. So you take it on a period-to-period basis because you know in which month that amount of taxes has been withheld and do it. But then it's best for you to take it in the year in which that income is included in the foreign country and in the residence country to that extent if you are able to do it. If for any reason you are not able to do it consistently on a year in which there's a overlap, higher overlap to that extent. Typically the problem is January, February, March.
Yes.
That is where the issue is. So whatever withholding has happened up to December, you take it in the year in which you have a March ending. In the case of January, February, March,
You have to take it in the next year, basically because it is considered in the next calendar year outside India. And then in India, you will have an overlap. Because it's only a smaller 3-month overlap, you can take it forward in the next year.
Okay.
But there has to be a synchronization of the income and the tax. That is important, and consistency.
Understood.
But the law does not address this issue. So one of the issues that you can address in some countries which permit you to have a April to March year end is best to synchronize the year ending, particularly whichever countries permit you to have a year ending which is other than the calendar year. The United States permit you to do that. So to that extent, the synchronization will help not because of US, but because of India. Because in India, they don't allow you to have anything other than April to March.
Okay. Thank you.
Thank you, CA Krishnan, sir. That was indeed a wonderful and knowledgeable session as well. I'm sure it was quite a knowledgeable feast, right? So, as a token of gratitude to CA Krishnan, sir, on behalf of Bangalore branch of SIRC of ICI, a small memento will be handed over. Once again, thank you so much, CA Krishnan, sir. The next session, we'll have a small tea break now. The next session is going to resume at 4:30. So let's all join back together at